The world is unfortunately facing a little storm of coincident forces that are producing a global slowdown, of which the trade war is the most notorious and well advertised, to the extent it happens at all, that is. Higher oil prices are also important, although they've partly unwound, and there has been a general issue of Fed tightening, Eurozone tightening, and a dollar shortage in non-dollar markets, all of which have contributed to what's happened. Well, what's happened is that in the last 6 months, the dollar is up by about 7%, and the yuan is down by about 7%, both trade-weighted and in real terms. And these two factors are pretty negative for the world economy, because both for the export-orientated economies and particularly the non-oil emerging markets, the rising dollar has raised the cost not only of their imports generally, but particularly of the oil, because the oil price has gone up in dollars, something which doesn't usually happen. Generally speaking, when the oil price is strong, dollar is weak, and vice versa. But this time, they're both strong together, which is double whammy on the import side for all of those guys who are export-orientated. Secondly, of course, their exports are threatened by the fact the yuan has fallen by 7% in real terms over the last 6 months. And as a result, Chinese exports are booming away, but of course the rest of the world, not so much. So what we have is that world trade growth has declined from 5 to 6% in real terms on a quarter-to-quarter basis earlier this year in the spring and early summer, to about 2% now, and probably going down further still, although the buoyancy of Chinese exports may obviate that. And the fall in export volume means that the uncompetitiveness of people's exports are a difficulty too. So the result is that you have difficulties of growth in Europe, difficulties of growth in Japan, where export volume is falling, also in Korea, and the Asian tigers, and non-oil emerging markets generally. And then because the dollar itself is very close to its all-time boundary on the upside, which is about 20% up from its long-run average, it is threatening to slow down the US economy, which enjoyed, I suppose, certain benefits in Q3 that are going to go away in future, such as a sharp drop in the savings rate, and of consumers, that is, and also a significant upswing of inventories. So where we are is that we are expecting significant slowdown in 2019 in the European continent, in Japan, in the Asian tigers, and in non-oil emerging markets, but also in the United States.